Welcome back to Mortgage 101, your guide to home ownership.
I think you're having too much fun.
Yes, with Clinton Wilkins and myself, Todd Veinotte. So we talked in our opening segments a little, I don't want to say doom and gloom, but
it wasn't rah, rah, rah like we normally go, is it? I don't know. Normally we are very positive people.
That's right. So, but that all said, though, we do need to talk about solutions because we discussed assessments going up, and we can dovetail interest rates into all of this, but the stress test. Talk about the stress test because I think that
and like what's going on right now.
Well, no, but why the stress test was applicable, for goodness sakes.
Yeah,
right?
I mean, any mortgage that was done since obviously changed everything, and the stress test came into play. B20, B21.
What is the stress test for those who don't know what the stress test is?
So the stress test currently, and at the end of the year, they decided that they were going to keep the qualifying rate the same at 5.25 or 2% above your contract. Obviously, with where the rates are right now, the rates are typically above 5.25% or 3 whatever.
Yeah.
So everyone is qualifying at a rate of contract plus 2%.
Right. And the point of that is that inflation can set in and things can happen.
Rates can go up.
And you need to have that buffer zone in your income.
Exactly.
Yeah. And
it's for everyone. It doesn't matter if you're in a variable rate or a fixed rate, you're all qualifying with the stress test rate. And currently you're qualifying at prime plus 2%. What's interesting, a lot of industry people like myself, we thought that maybe the minimum qualifying rate might be increased above 5.25.
Right.
It wasn't last year.
Yeah.
So that means that typically we'll go the whole year until the end of next year, and they're going to decide, does that minimum qualifying rate need to be changed? I don't know. A lot of economists think that by the end of this year, we may be in a recession type situation, Todd.
Yeah.
And if we're in a recession type situation, that means that the rates really could go down. And, obviously that's going to impact what happens with the Bank of Canada. It may impact the bond market.
Mm-hmm.
We'll see what happens with rates. We don't have a crystal ball.
Yeah.
I think that the rates still may be high for at least another year. So I think that's what we need to bank on.
Yeah.
2023, high rates.
But the stress test is there to protect the consumer, right?
It is. And consumers are protected. The CEOs of the Big Five actually, met. There was in the news this week, and they were really talking about mortgages. Obviously, it's obviously on the front of everyone's mind.
Right.
Obviously, they we're all talking. And are there some mortgage arrears? Not really just yet, but they're projecting that as much as maybe 2.5% of consumers may get into some mortgage arrears later this year, depending what happens with rates. Typically, I will say that Canadians make their mortgage payments.
Yeah.
That's the very last thing that they are unable or are not willing to pay.
Yeah.
So Canadians typically will make their mortgage payments. And I will venture to say these bank lenders are not going to see a bunch of foreclosures. You want to know why? People that are able to qualify for a prime mortgage typically have cash or credit.
Yes.
They're able to weather the storm for a longer time than someone that's in an alternative mortgage maybe, or someone that's in a private mortgage.
Yeah.
Those are the ones that I'm really most concerned about. I think the most vulnerable are the clients with the highest interest rates.
Yeah. And listen, I have people sometimes they'll call the show or I'll get emails from them. They'll say, look, we're in a the sky is falling scenario. And they'll look at what happened in the United States in 2008. And I say, look, there's zero comparables to what happened in the subprime.
Not even close.
Right, not even close. So let everybody know just a couple of reasons why it's not even close for those who are saying, oh, we're heading towards what happened in the United States.
Well, I think at that point there was the access to credit was really
they
diminished.
were giving everybody a mortgage.
Yeah, exactly.
Yeah.
So if you had a heartbeat, you could get a mortgage. In Canada, we are definitely more conservative.
Yeah.
Comes back to this point about the stress test.
Yeah.
You have to qualify on a higher interest rate because when you qualify, the bank and the federal government wants to know that if the rates go up, you can still afford your home.
Yeah.
Right? And that's what's happening right now. Did we think inflation was going to be a runaway train? We talked about inflation basically all year last year.
We should have known.
We should have known.
Yeah.
And the rates only really started increasing the back half of the year.
Right.
But now we've had 6 months, 12 months of higher rates, and now we think the sky's falling.
Yeah.
No, it might be another 6 months or 12 months, and things will soften. It's like consumers that are in a variable rate. It's not going to be high forever. It's not going to be low forever. It's variable, right?
Mm-hmm.
Historically, it's better. And obviously, some people that are in a variable right now are paying more money.
Yeah.
And are they paying more money than if they were in a fixed? In some cases, yes.
But that said, I'm in a variable. So I'm paying hundreds more for my
Mm.
mortgage. that all said, I would almost rather do that than be in something extremely low and have to renew in a
And
year.
shocked.
And be shocked, right?
And
At
I'm
least you
seeing
grow
that-
into the increase,
I'm
right?
seeing that right now,
Yeah.
and I think those are the hardest conversations.
Yeah.
It's the clients that are coming up for renewal that are like the sub 3%.
Yeah. So
They
people
are
are at
shocked.
2.5%, 2.9%.
They are shocked.
Yeah.
They are shocked.
How much is it going up for them?
In some cases, their interest rate is doubling.
So on a typical payment, biweekly payment,
Well, their payment's not going to double, Todd.
No, I know that.
So,
but
their
what I'm
payment,
saying is,
their payment might be 50% more, though.
right? So we're talking.
That's significant.
Yeah, we're talking hundreds and hundreds of dollars a month more.
And I'll tell you what we're doing, and this is a really good time to talk about a little bit about solutions. I'm talking to a lot of clients that are not originally, we didn't do the mortgage. These are clients that are coming to us from another financial institution,
Yeah.
and maybe a mortgage broker did it, or they went directly to the bank, and they're coming to us for advice about what should they do to make their situation better. In many cases, a bank lender, they don't want to rework your mortgage to extend your amortization only. They want to, if you're going to rework your mortgage, they want to lend you more money, so they want to pay off some debt or something like that.
Yeah.
So I have clients that are coming from some of the big five that we don't even do business with, and these clients want us to do the transaction and not borrow any more money, Todd.
Mm-hmm.
But what they want to do is they want to extend their amortization 25 or 30 years.
Right.
I have clients that are they have 10 years left or 15 years left or 20 years left,
Mm-hmm.
but they need a longer period of time to pay that principal
Yeah.
because they need to have a lower mortgage payment. So we're certainly having those conversations. We're certainly having a lot of conversations for clients that bought a home prior to 2020 because they still have a lot of equity in their homes.
Yep.
And are the values as high as they were at the peak? I don't think so, but I don't think the property values have gone down.
Mm-hmm.
There's just not as many transactions happening right now. And
Yeah.
are things going for as much above asking as they were? No. But I think that certainly there's a lot of borrowers that have a lot of equity in their properties, and those are the ones that we're doing a lot of these transactions for. And sometimes they're pulling out equity to maybe pay off unsecured debts. I mean, it's January. It's Merry Debtmas.
Yeah.
We're starting to open our credit card statements. Maybe we spent too much money last year. Maybe we spent too much money during the holidays.
Mm-hmm.
And some of these consumers are doing a refinance and pulling some equity out of the property, and that's putting them in a better financial position. But I would say even more than that, we're talking to people a lot about amortizations, and people are definitely taking longer amortizations now than they were before.
Yeah. Yeah, and that's for some people. Look, I think the concept years ago was pay the mortgage down, never do that. That's
Pay it off, be
pay it
mortgage-free,
off, mortgage
discharge
free.
it from your property.
Right, but I think people now are even into their senior years are looking at their homes as in a different way. Right? Is that safe to say?
Let me tell you, I see so many people before they retire, if they don't have a mortgage on their property, they're putting a home equity line of credit on there because they can qualify, they have the income.
Yeah.
And it's really prudent to have a mortgage charge on your property because things like mortgage fraud, it doesn't happen that much in Nova Scotia. But let me tell you, in other areas of the country, it happens a lot. And when you own your property free and clear and there's no charge on there,
Yeah.
you're
a
basically
target?
opening yourselves.
You're a target.
You're a target.
Yeah. Yeah.
You're a target.
Yeah.
And there was a news story coming out, I think, of Ontario in the last couple weeks. A couple was on vacation.
Yeah.
They were away for a couple weeks.
Yeah.
So, fraudsters made their IDs, sold their property free and clear.
Oh my goodness
out from under them.
gracious.
Wow. The buyer, the legitimate buyer from
Yeah.
these fraudsters was living in the property.
I shouldn't laugh. I don't laugh. By the
It's
way.
a terrible situation.
It's a terrible situation.
But when you own your house free and clear,
yeah, they can't.
you're
do
opening
that.
yourselves up. So I would say at least have a HELOC on your property, a home equity line of credit.
Yeah. Right.
I would say that is going to protect you. And then at least you have a lien on there. You don't need to owe anything on it,
Yeah.
but it's a great way to protect yourself from potential title fraud.
All right. So when it comes to mortgage, to variable versus fixed, you've been a strong, ardent supporter of a variable. You still are.
I still am.
Okay. Tell us why.
I can tell you there's more clients today taking a variable rate than there are a fixed.
Yeah. Tell us why.
And in many cases, variable today is more expensive than fixed.
Variable is more expensive than fixed.
Today, in many cases.
Yet you're still advising that they do that.
And clients are still wanting to do it.
Well, state
I'll
your
tell you
case.
why.
Yes.
One, they think there's going to be a recession. And they think that if there's a recession, the Bank of Canada is going to lower the key overnight rate,
Yeah.
which will obviously impact
What's
the
the
cost
time
of borrowing.
horizon for that? A year?
A year.
Yeah.
We'll say a year.
Yeah.
Secondly, if you break your mortgage early
Yeah.
in a variable, you're only going to pay a penalty of 3 months interest to get out.
Right.
So Canadians, we like to break our mortgages.
Yeah.
Sometimes we break our terms early.
Yeah.
If you're in a variable, 3 months interest.
Yeah.
All right.
Yeah.
Thirdly, that variable is always convertible into a fixed rate with your
Right.
existing lender.
Yeah.
So imagine the fixed rates go down
Yeah.
and you're like, hey, the fixed rates are now half of where they are now, and you really want a fixed rate, you can convert with no penalty.
Yeah.
The downsides on the fixed are they're quite high right now.
Mm-hmm.
And if you break it, you're going to pay a massive penalty to get out,
Yeah.
especially when the rates go down, because you're going to pay something
What
called
if somebody
an interest
says,
rate
"Yeah, we're not
differential."
going to break it. I know we're set. We're not moving. We're not going." What do you say to that?
What happens if you have health issues?
Yeah.
What happens if you have matrimonial breakdown? What
People
happens
have
if-
matrimonial breakdowns?
Believe it or not, it happens like 50% of the time.
I think it's more than that, but
Could be more than 50.
yeah.
And I'm not against fixed rates. Don't get me wrong.
Yeah.
Don't get me wrong. Fixed rates are for some people. I think if you're at the top of your budget, you're borrowing the maximum you can afford, and you need to know what you're going to pay every month. You're going to lose sleep at night.
Yeah.
A fixed rate is viable even at today's rates.
Right. Yeah.
It's not for everyone, and I think you need to understand the risks of both. There's risks and reward no matter which choice you make.
Yeah. But it must be, I don't want to say an annoying day, but when rates go up and the phones are ringing from people who are panicking, you must be talking to a lot of people kind of down off the ledge, right?
You know what? We have these conversations all the time, but what I think is really powerful, we really try to get ahead of it. We're all about communication. You have a variable rate mortgage. I have a variable rate mortgage.
Yeah.
We like to pump the communication out. We sometimes will send a communication out before the Bank of Canada even meets.
Yeah.
When the Bank of Canada does meet, we'll send an SMS. We'll send an email. I'm
You're
live on
doing
Facebook. I'm on City
my
News.
Show, yes, yeah.
You know, we're trying to pump out as much communication as possible, so then borrowers are really comfortable and they know what's going on. I can give the advice. And in some cases, clients have chosen to lock in.
Yeah.
They might not have locked in with their existing lender. Sometimes we'll do a transfer to another lender. And I on the show, I think the last couple of months, I said, a 3-year fix is very popular right now. I will kind of change what I'm saying. I would say mostly it's 5-year fixed and 5-year variable, and we're doing more transactions in a variable rate right now than we are in a fixed.
Yeah. Okay. So we've got one more segment left. I do want to ask you about new Canadians and getting new Canadians, because this must be a big part of your business.
Yeah,
I'm
certainly.
assuming.
It certainly has been, and there's been obviously some rule changes with the federal
Okay.
government.
So that and a lot else coming up in the next segment. Mortgage 101, your guide to homeownership. We'll be right back.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.